Trouble hearing us? Okay. Technical difficulty. Okay, in the chat here, let's see. Really hard to hear you guys. Okay. Sorry about the technical difficulties. We're trying to fix that up real quickly. We're getting better. Somebody can shoot us a little message. We're going to keep talking just a little bit. We appreciate the chats. That really helps. Better. Okay. Thank you. Great. Thank you for letting us know that. Sorry about the difficulty there. Steve and I are not computer experts. We got some wonderful folks that are helping us here at SRH. Okay. We'll proceed from there. And then obviously somebody jump in there if we need to, if it gets worse.
Why don't you just do a quick recap of the traditional, because some of them said they barely heard anything. So
sure.
Maybe run back through that real quick.
Yes. Simplest form of retirement plan. We can put 6,000 if you're under age 50. If you're over age 50, you can add a catch up of 1,000. If you do have an employer plan at work, say a 401k, 403b, simple IRA, it can limit your tax, deduction. You've got all the way up until April 15th of the following year. So for 2021, we can go all the way to next April 15th and make contributions. If you've got earned income and a spouse doesn't, you can make contributions for both of you based on that part. So let's look at the chat and see. Okay, much better. Okay, great. So we're off and running now. And then people ask me all the time, Brandon, what can I invest those dollars into when I put it inside a traditional IRA? And when you put it in an IRA, you're putting it basically into a brokerage account. It does have the IRA wrapper, but inside that brokerage account, you can use mutual funds, you can use stocks and bonds, you can use an annuity if you want an income payment. There's also IRAs out there that invest in real estate, gold and silver. You hear advertised on the TV. So there's a very long list of items that you can use to invest dollars inside these traditional IRAs.
When you get into those non-traditional types of investments, though, like real estate and precious metals and things of that nature, that becomes very technical very quick. And there's a very limited number of IRA trustees, custodians who handle those types of accounts. So, and then you sure better understand what you're doing. Right. You don't want to gamble with your retirement money. So.
Yes, absolutely.
All right. What about the Roth IRA? It's interesting to me that these have been out for how long now?
Oh,
25 years?
Pretty my entire career. Year 23. So
all right. So 20, something like that. And I would say 90% of my clients still cannot express to me the difference between the two. And it is confusing.
Sure.
But it's some very fundamental differences.
Yes.
Both the traditional and the Roth have their place.
Yes.
So why don't you talk a little bit about the Roth and
yes. So same contribution limit. Okay. And if you're wanting to fund some traditional, some Roth, the limit applies for both. So I mean, 6,000 if you're younger than 50, only the 1,000 to catch up extra. But you're actually you're not getting a deduction. You're going ahead and paying the tax on the front end, but then the growth inside that Roth, you never pay tax on the growth. So certainly can be a great vehicle. There are some income limits on the Roth IRA, depending on whether or not you're single or filing, joint and married. So you have to be careful about that. Work your CPA. But if you can make a contribution, certainly we have a lot of people that like, and it's got the same deadline, April 15th of the following year. But the tax-free earnings pretty significant.
And for me, the biggest attraction would be someone who's young, very young, because then you have time on your side for all these this to grow tax-free year after year after year after year, and basically help catch up and surpass the loss of the tax deduction. It gives you time for this account to grow and grow and grow. And then, wow, think about a tax-free income at retirement. That's amazing. But you don't have, it doesn't really, the numbers don't really work as well if you start doing Roths when you're very close to retirement. It works really well for someone who's quite young.
Correct. Yes, absolutely. But even when you get into retirement, let's say you've done all traditional, either through your 401k or your IRA, there are options for doing conversions.
Mhm.
So you could have some Roth money later. I kind of like as an advisor, people having both buckets to dip into because, and this, I mean, we are in a graduated tax scale. And so as you go up the ladder, so to speak, and you're pulling dollars out of your funds for retirement, if I've got a Roth bucket, then maybe I can stay out of some of those higher tax brackets.
Right.
So it gives you just options.
Well, and we see a lot of our clients where one spouse might do a Roth and one might do the traditional.
Sure.
And it works well in that regard.
Give you a little bit of both.
Mhm.
Okay. Same type of investments.
Yeah.
From a traditional IRA that I just listed before, you can do all those same things for a Roth.
Yeah, but again, the biggest downside of just relying on a traditional or a Roth is the limitation on contributions.
Correct.
The amount that you can put in each year may not get you to where you want to be in retirement by doing only that.
Correct.
So that's the thing to keep in mind.
Yes. All right. I think the next screen's got information about the traditional Roth as well. Okay, I'm getting down, but it's not. Apologize, it's not going down.
Let's see.
There we go. Sorry about that. Again, I think we may have already covered this particular piece. Taxable distributions, or tax. People ask me all the time, Brandon, what's the tax rate going to be when I take money out of my traditional IRA? And it just depends on where Congress has set the tax rates and the guidelines at this moment in time. You do have what's called a required minimum distribution, and that just got changed. Used to, for years, it was 70.5 is when you had to start doing required minimum distributions. Now say 72.
Right.
So they extended that on out.
Now you can do it earlier.
You can do it earlier.
Anywhere,
Absolutely.
starting at age 59.5 without penalty.
Yes.
So you can start as early as then, but it's mandatory now at age 72.
Yes. So Uncle Sam's going to start making you take dollars out there at 72 if you haven't been taken out. And as it works out as a percentage, I just tell folks per 100,000, it's about 3.6% or $3,600 per 100,000 you've got in the IRA is what you have to pull out. So you can take that number and cut it in half or multiply by 10, whatever your amount is. That's what you're going to have to start pulling out. And it's actually, there's a formula,
right?
And the government wants you to pull more out every single year going forward from there.
Right.
So
technically, it's based on our life expectancy, and IRS says we're all going to live to like
120. I'm personally not interested.
Something like that.
Yes. For last year, the RMD did get waived, which is very rare. That was due to COVID and that whole situation. But for 2021, there's been no changes, and you have to take your required minimum distribution.
And you pick up just as if you were before. You don't have to go back and take one for 20. It's you just take a normal 1 year RMD for 21.
Yep. Yeah. We talked about the early penalty. If you're trying to take money out before 59.5, there is that 10% penalty tax. Conversely, on the Roth, the distributions are non-taxable because I've put that money in and pay tax on the front end. It's grown tax-free. There is no required minimum distribution, right? Because I've already paid the tax. But yes, before 59.5, there is a 10% penalty. Unless you've had it for 5 years, there's little wrinkles, folks, and everything that the government puts regulations on. If you've had it for 5 years, you can go in and pull out your contributions, right? But you've got to have it for 5 years. Right. So there are some opportunities to get to some of those dollars. Okay. All right. SEP IRA. I know you see this a lot.
Do see this a lot. And if you are self-employed, and let's say, for example, you primarily employ family members, or you work on your own, you're self-employed, you don't have employees, we see this plan in those situations most often, and not typically where you're self-employed and you have, say, a number of employees. And I'll explain the reason why here. And it's primarily because the employer makes all the contributions in this type plan. So if you have a SEP, and it's you and your spouse in the business, it's an ideal type plan for you to get a lot of dollars into retirement each year, get those tax deductions for making those contributions, and without having to pay a lot of contributions for employees. Very few employers are going to want to make the types of contributions that are required here for employees. So for example, for the employer, you, the self-employed person, to get say 20% of your net profit for the year into a retirement plan, you would have to make retirement contributions equal to 25% of your employees' annual wages. So
Correct.
I have one client who actually does that of all my clients.
Sure, but it's an option.
It is an option. It is an option, and it does allow the self-employed person to get more dollars into a plan than some of the other types of plans that we have discussed.
Yeah, certainly way more than the traditional IRA.
Oh,
we
yeah,
discussed
yeah.
previously.
So what we're
And
looking
there's a
at,
deduction for putting the dollars in.
exactly. So we're looking at up to $58,000. So 20% of net profit up to a maximum of $58,000 a year. That's quite a bit of money to put into retirement
Yes.
for most employers.
Yes, and on $58,000, that's a huge tax savings.
Right.
On that 58,000, from that standpoint.
Absolutely.
And these plans can actually be established all the way up until you've extended your tax return
Right.
the following year.
Right.
So,
Yeah.
even past April the 15th, you can establish and fund these plans looking back to the previous 2020 year.
Yeah. So for
So-
example, you get to your April 15th deadline and you think maybe you still would like to do a contribution for the previous year, you can file an extension to October 15th.
Yes.
And you have until that time to establish the
Yep.
plan and make the contribution for the previous year. So it's a great tax planning tool, kind of after the fact.
Yes.
You know,
So you
so-
can already almost know what your whole 2021 year looks like before you make the contribution for 2020.
Sure.
So-
And I've had many situations with clients where they just didn't have the cash flow by April 15th, and they were able to get the cash, by October 15th to make the contribution. That's
Yes.
happened many times.
So you'll see on eligible employees, age 21, worked 3 out of the previous 5 years and have made 650 in the current year. So if you have folks that are in that category that fit in those, then yes, they would have to be eligible to participate if you're sponsoring and doing one for yourself
Right.
in that scenario. But once the money gets in there, it's just like a traditional IRA. All the dollars are going tax deferred. If you try to take money out before 59.5, you get the 10% penalty tax.
Right.
When you do start taking money out for retirement, if I take 30,000 out to supplement retirement, it's just like I earned $30,000. That's how I get
Right.
taxed.
Right.
From that standpoint. So it works very similar once the dollars get into, it's an IRA. That's why it's called a SEP IRA.
Right. So once again, very, very popular with self-employed folks, especially if it's all within the family, so to speak.
Yep.
And it is not as popular for those self-employed persons who have employees,
Yes.
just because of the high funding requirement on the contributions and the fact that the employer has to make all the contributions.
Yes, there's no employee contribution
Right.
at all.
Employees
SEP.
cannot defer into these. These are
Yes.
all 100% employer contributions.
Correct.
So, all right.
Okay,
I didn't see any Q&A on that one. I was expecting a question.
sure.
Uh,
Well, we can certainly answer questions as we go as they come up.
Okay.
All right. Simple IRA. You said earlier, seeing a lot more of these
I
today.
see a lot more of these today. And they've been around for quite a
Yes.
while, works very similar to 401k. A lot of people say 401k generically, as that's their company retirement plan, because that's what a lot of companies have.
Sure.
But a lot of small employers go with a simple instead of the 401k.
Mhm.
One of the reasons is the cost of administration,
Yes.
and the amount of testing that has to be done on contributions and that sort of thing. And so there was a question there that came up: are partners eligible for a SEP plan? And so yes, you can.
Mhm.
As long as it is what we call a trade or business, where it's self-employment income. Now,
Yes,
if it was a partnership that was a rental or something like that,
correct.
couldn't do it.
That's
because
passive income.
rental income is considered passive.
Yes.
Basically, the government says all you do is collect one check a month, although we all know there's more to it than that.
Yes.
But yeah, it has to be an active trade or business where you're selling a product or a service. If it's that type of partnership, then yes, partners can do SEP contribution.
Yes.
Okay.
And if we don't get your question answered, I mean, it's gonna be very easy for you to follow up with Steve or myself, either
Sure.
one, and us dive a little deeper if we need to.
Absolutely.
So hopefully, I hope that answered that question.
All right, so let's jump back to the simple.
Yes.
So basically, it works like a 401k in the sense that employees they defer part of their wages into the plan, so they're
Yes.
making retirement contributions throughout the year. The owner of the
Yes.
business, the self-employed person, can also make
Contribute.
contributions.
Yes.
Now, the thing to keep in mind is on these deferrals, they have to be in by January the 30th of the following year. I have sometimes,
Well, for employees, it's gotta be
Yes.
12/31.
yes,
For an employer, if they're making a deferral, it's gotta be about 1/31. You know,
Right.
so you get a chance to look at your end of the year before you make your contribution, then it's gotta be in.
right. And run into that problem sometimes when it comes tax season.
Sure.
The client doesn't come to see me until February,
Yeah.
and then it's already too late to make that deferral. So it's one of those things we need to be talking in the fall, you know,
Yes.
and during tax planning about
Yeah.
how much they're hoping to put into that retirement plan. So there are some little things that can trip you up here. You got to be aware of the dates and the requirements there.
If you're wanting to set up a plan, you've never had one before, you've got till 10/1 to set up a plan for this current year. So in 2021, I've got till 10/1 to set up a plan.
Right.
Of course, the notice has to be put out. You have to, everybody that's eligible has to be able to participate. And there's a couple of things we can change about the eligibility, but basically, if somebody earns, $5,000 in the previous year or current year, expected to earn that amount of money, then they're eligible.
Okay.
So there's not many moving parts. Again, it's simple
Mhm.
from that standpoint.
A
It's
100 or fewer employees, so
yes.
there is a limit on the size of company essentially that can use these
Yeah.
types of plans.
UPS is not going to use this type of plan.
No.
They're too big.
They're too big.
Yeah.
It would not be.
They'd be a
eligible.
401k.
Right, right. And so there's the contributions by the employees, the deferral we call it. There's the contributions by the employer. And then there can be, on top of that, there can be profit sharing essentially. Employer contributions that they're making to match what the employee is putting in, et cetera.
Yeah, typically what we see is the deferral limit is 13,500 if you're younger than age 50. If you're over age 50, you can do a $3,000 catch up, just like you do a catch up on the traditional IRA and Roth IRA. So that's a maximum of 16,500. And then what employees are put, basically for an employer contribution, you can put in 3% of that. You can match their compensation 3%. So if they're doing one, you've got to do one. If they're doing up to three, you've got to match three. There are some provisions where you can take a year off if there's a hardship, COVID being a hardship
Right.
for a lot of employers this past year. But then you've got to pretty much go right back to making that contribution going forward. But everybody has their own separate IRA. So then once the dollars are in the IRA, it's the same thing as the traditional IRA and the Roth IRA as far as what investments can be used
Right.
and how to take dollars out in the future. There's the 10% withdrawal penalty. The first 2 years, though, on a simple, is 25% is the withdrawal penalty
Right.
if you're withdrawing it early.
Right.
So, but once you get past that first 2 years, it's the regular 59.5,
Yeah.
10%.
And what you just mentioned about those individual IRA accounts is a very important distinction because with the simple, it's like, well, let me back up. With a 401k, the assets of the plan are pooled essentially, and then divided up based on allocations and how the individual participants want their money invested. And so it's in a large plan. With the simple, literally each employee sets up a separate individual IRA account over which they have control.
Total control.
So once they put their contributions in and the employer puts contributions in, there's nothing to stop them from turning around and taking them out. It might probably be a bad decision financially for them, but there's nothing to stop them from taking that money out because they own and control those accounts from that point forward.
They also make the investment decision, which means the employer doesn't have to make the investment decision.
And that's a nice thing because, there it can get a little sticky sometimes. You feel like as an employer, if you have a 401k, you have somewhat of a fiduciary responsibility to offer good options for your employees. And so with the simple, you don't have that liability. The employees are making their own decisions about how to invest that money.
So we see the simple IRA a bunch for small employers. Probably nowadays see it more often than we do anything else. Obviously,
Absolutely.
with large employers, it's the 401k. We're going to go into that in just a second. But I know there's quite a few. This was supposed to be about small business retirement plans. The simple gets used a lot.
It absolutely does. And I've become a real fan of it. It works really, really well for
Yes.
most of our clients.
Yes. Okay. All right. No
There's no
questions?
questions.
Let me see here. Okay. The max if you're younger than age 50, the max contribution is 13.5 as a deferral. And then you can actually match that contribution, and the match depends on your taxable income.
Right.
And so that's a calculation. Sometimes it has to be done obviously the next year.
So the match can be more than that 13.5.
Well,
you're not just matching with the deferral, right?
No, it is the deferral. So the
Okay.
maximum it would be is the 13.5.
Okay.
If 13.5 is what you put in, and then if you get over age 50 and you do the 16.5, and your income allows for enough income to match the 16.5, then it would in that scenario.
Those were some examples I
Yes.
was thinking about.
Yes.
We had some
great
employers
question.
who were over age 50. So yes, you're right there on that question.
Yes, absolutely. Great question. Thank you for the question. Okay. I'm gonna head on to the next round here. Oh, sorry, I went too far. There we go. 401k. Must establish by tax filing deadline, including extensions. Don't see that very often. Usually we see these kind of start towards the beginning of the year.
And it would make more sense to do that.
Yes,
You lose your ability to have any real benefit out of it if you wait till the end of the year to
yes,
start the plan.
yes. Does have a higher contribution limit. So 19.5 is the employee, and or if you're an employer participating, you can put 19.5 in. So it's not a percentage, it's a dollar amount, which you don't have to put that amount in. The catch-up contribution is larger. It's 6,500. So if I'm over age 50, I can put $26,000 in. That's a pretty substantial amount. There are some wrinkles to that though if you're the employer, because there is this thing called testing that happens with a 401k plan, where the government makes you submit a spreadsheet every year to a third-party administrator. Usually it's kind of the gatekeeper.
Right.
So there's a few more rules and regulations on the 401k that do not apply to the simple we were just talking about.
Right.
Testing is one of those. And so the government looks at the guidelines of what owners or highly compensated employees are putting in versus what they call non-highly compensated employees. That's something that has to be done every single year. And so you could be limited on what you can put in as an employer, depending on how you set the plan up.
Now, those are tests that are usually performed by what we call a third-party administrator.
Yes.
And someone that you would pay each year to perform those tests.
You have to have that piece, because again, those folks are the gatekeepers. So the rule, they understand all the 401k rules, which can be very complex. It's a document that's obviously, anything the government puts together.
Right.
It's going to be a pretty big document. You can make Roth contributions, so you can do pre-tax or do Roth. The interesting thing is there's not an income limit on the Roth 401k versus the Roth IRA. On your Roth IRA, you could be limited based on your income. On the Roth 401k, there's not a limit. So for income, which is kind of, again, you finger Congress out, you let me know. So very complex ERISA rules, as we alluded to. Employers can make a match contribution. They can make what's called a profit sharing contribution. So there can be several options. Typically we see these again for larger employers, but small employers can use a 401k too. You can allow for loans with participants, but you don't have to. There's what's called an adoption agreement that runs your 401k, and there's lots of boxes you can check on eligibility and do I want to allow loans, or what types of hardships do we want to allow. Some of it's formatted that the government gives you strict guidelines, some of it you have choices on. Your adoption agreement that you sit down and go through with your third-party administrator and your advisor is how you set up all those particular pieces. The $58,000 contribution total limit is deferrals, employer contribution, getting back to that same number that the SEP IRA had from that standpoint.
And we don't want to suggest that
Yeah.
this is only for large employers.
Yes,
It is somewhat dependent on how much money you want to get into the plan. This
yes,
would allow you to get more in than a simple.
Yep.
So there are even individual 401k plans.
Yep.
So a self-employed person with no employees may very well have their own self 401k plan.
Yep. Solo K is what it's called.
Right.
Yep.
So it's really driven by the number of dollars, I think, typically that you're wanting to get into retirement.
Yes,
So.
absolutely. The employer usually picks a lineup of funds that are available for everybody, and then once a participant starts participating, then they can choose from that lineup of investments. But some of that investment, fiduciary responsibility falls back on the employer in the
Right.
401k world versus the simple IRA that we were talking about earlier. So again, just quite a few more moving parts on the 401k, but again, it's a vehicle that we see quite regular. And it's a fantastic vehicle when it's used in the right scenario. A little more setup cost
There is.
involved, especially when you put that third party administrator piece in there.
But very well may be worth it.
Yes.
If you're wanting to get the extra dollars.
Yes, absolutely. Well, our explainers must be working pretty good. We don't have a question there unless somebody throws a question in the chat or the Q&A, the 401k. We usually get one. If one pops up, obviously we'll jump in there. Okay, defined benefit plans. You mentioned this earlier. So what we've been talking about is defining the contribution, traditional IRA, put in 6,000 and $1,000 catch up. The simple IRA can put in 13,500 or 3,000 catch up. In a defined benefit world, I'm not defining the amount I can put in. I'm defining the amount in the future. So I'm trying to define an income stream that I'm going to have later. So you're defining the benefit at the end, and that can depend on how it grows, as to how much I fund each year and how much time I've got between now and retirement.
And an assumed investment rate.
Yes,
Yeah,
absolutely. Yes, absolutely.
There are a lot of assumptions involved in these types of plans, and I guess that's the imprecision of it, and part of the cost involved in continually having to recalculate, revamp, take a look every year at where you are on the track to getting to the goal that you have in mind.
But I know we've worked together on a few defined benefit plans. In the right scenario, I know 58,000 was the max that you could put in all contributions to like a 401k or a SEP IRA. We've seen some situations where somebody can put away 100 or 200, depending on what they're trying to find for the future, get a deduction, even larger numbers than that, depending on the situation. So it's very much an individual conversation. We see it more for folks that are a little bit older, potentially have a little less time between now and retirement. They can get a lot of dollars put away in a short period of time.
And really works to the advantage of people like employers who are older.
Yes.
And potentially have much younger employees.
Yes.
That it really works to their advantage.
But it is a qualified plan. So therefore, because it's qualified and the government's got their hands in that pot, so to speak, there are guidelines. And if you were sponsoring a plan for yourself, you've got to include people. And so there's lots of guidelines. The third party administrator, very important piece of the defined benefit plan, because they're the folks that understand all the calculations on how much you can put away in each circumstance. So they're even more important in the defined benefit world than they are in the 401k world. To work very closely with the third party.
And I think they earn every penny they make. It's it's very technical.
When it says complex ERISA and IRS rules, it's absolutely
Definitely.
Yeah, for sure. And that's over and above with somebody like a financial advisor, myself, or Steve as a CPA. We've got to have that third party. We can help on the tax side, the investment side, but that third party really understands all the guidelines and rules. And there's very complex calculations as to how much.
It's a whole industry unto itself.
It is. But the dollars going into are tax deductible. They grow tax deferred just like they would in the 401k or traditional IRA or simple. You can put a vesting schedule on there if you got employees that you're having to put into that particular scenario. And then usually what we see at the end is once you funded it and you're retired, usually it gets rolled over to maybe a traditional IRA. And of course, the distributions from there are just like they would be under all the other rules we talked about before. But it does allow somebody to put away some significant dollars if that fits their situation.
Sure.
And that is what they're looking for. But you're defining the benefit in the future, not the actual contribution.
So I guess to kind of summarize this, this is one of those things to tuck away in the back of your mind. If you're wanting to get a lot of dollars in much above the 401k limits, this is something to talk about. Absolutely.
Yes.
It would be great if everyone was in that situation, but it's not necessarily for everyone. Not everyone has the ability to put those kinds of dollars in every year.
Yes. And you used to have to establish the plan before 12/31. In the Secure Act that was passed at the end of 2019, they actually extended that.
Right.
So you can actually go into the next tax year, kind of like on a SEP IRA, kind of look backwards and see where you are, and actually put the plan in force and do all the documentation that has to be done. So a lot more flexibility there, especially for employers and CPAs to make decisions now that you can extend it past that 12/31 deadline. To actually contribute, start a plan. I tell most folks if they want to do defined benefit, you need to really be committed to at least 4 to 5 years of funding.
That's correct.
And that's kind of how those rules are set up. So whatever number you come up with the TPA, just kind of think in your mind, I need to do this for 4 or 5 years. Now, there's always an escape hatch for catastrophic things that can happen in business. We've all dealt with small businesses and they can ebb and flow. COVID, who in the world could have seen that coming? But so there are escape hatches. That's not a hard and fast, but generally speaking, 4 to 5 years is
you're pretty much locked into making those contributions
unless something catastrophic happens on that part. Okay, no questions on that. Man, our explainers are working good today. We appreciate everybody's participation. That's put questions in there today for sure. All right, let's go down just a notch here. Non-qualified deferred compensation plans. So where we typically see these is you've kind of filled up the 401k, so to speak, or other plans. And then maybe you've got a group of either executives or maybe key employees that you want to carve out,
or directors
that you want to carve out and do something special for. So that's where the non-qualified deferred compensation plans typically come into play. There can be deductions. It can be funded or unfunded. It can just be a promised benefit in the future. Don't see these as often as we do the other plans like the simple, the SEP, the 401k, even defined benefit. But yes, it's certainly an option that's out there that can be used.
Sure.
And the neat thing about it is not everybody has to participate. You can kind of carve out a group of folks that specifically you want to try to enhance their benefit somehow, some way, is where these plans
not be a way to attract an executive or whatever.
Yes.
To add this extra benefit onto their package of benefits.
Yes. And small employers certainly can use these plans. We do see them more often with larger employers, but small employers certainly can use these as well. Again, there's some wrinkles. So having a third-party administrator is a very important piece, just like on the defined benefit. They're a critical piece of that part. Okay. So I think we've kind of run through the main types of plans.
Right. I would think some of the things to think about is you go back and ponder, well, which one of these would work for my particular type of business? The main things I think to think about are probably whether or not you have the ability to fund retirement contributions or matching for employees.
Correct.
That's a big consideration. Looking at the total number of dollars that you have available or are willing to commit to funding retirement each year, that's a consideration. Also, where you are in your timeline to retirement. Because the planning could be different if you're 25 versus 50. Well, it would be different if you're 25 versus 55.
Sure.
The planning would be totally different as to how much and the different types of things that you're able to achieve in that time period.
Yes.
So those are some big factors. The cost is always a consideration in these different types of plans. Some are very inexpensive, virtually no cost, all the way up to having to have TPAs and actuaries and
Yes.
folks involved. But if you're trying to get in those big dollars, to me, it's well worth spending, whatever it takes to be able to.
If it costs me $3,000, $4,000, but I'm able to put away a couple of $100,000 and get a tax deduction,
Sure,
that's
that's a
what you're-
no-brainer.
Yes,
Yeah.
that's exactly right. There's a cost involved to put all that together
Sure.
on that piece.
The biggest thing I would say is just sit down with someone.
Sure.
Don't try to navigate all this on your own. I know we didn't give you everything you need to know today to make decisions. But hopefully we gave you enough that started the questions.
Yes.
And maybe you jotted down some things and started having some thoughts. Sit down with some professional like Brandon who can walk you through that decision-making process.
Question on ESOPs. We didn't cover that today. I typically see that with our larger employers. And this was more geared towards small and employer retirement plans. I very rarely see that for a small employer.
Right. ESOP being an employee
Employer.
stock ownership program
Yes, yes.
or plan. And that's essentially where you're gaining shares of your employer's company.
Yep.
And those shares are the investment that is in your retirement account.
Yes.
So very technical,
Yes.
it's very highly regulated. You're going to have those third-party administrators
Yes.
involved.
It's got to be valuation of the company done every single year.
A business valuation
Yes.
done to value the stock.
Yes.
So
So expensive.
and that could be $10,000 or more a year
Yes.
in cost just for the business valuation.
Yes. So great question. I just don't see it very often with small employers, typically with a larger employer.
Around here, just for example, probably the only employers I've seen that are some of the national companies, maybe some larger banks or some of the agribusiness type companies that are large, either national or regional type firms can afford that type of thing.
Question about 401k contribution max.
Okay.
So 19.5 on the deferral if you're younger than age 50. If you're over age 50, then you get that extra 6,500 of catch up. So 26,000 of, but you gotta have 26,000 of earned income to get that 26,000 in.
And
from that
so
standpoint.
He writes in, we're
Yep.
getting close to retirement and we want
Yep.
to max out our contributions.
Yep.
But this year we have another employee eligible to start
Yep.
contributing.
Yep.
Okay. So that employee can contribute out of their own wages.
Yep. In defer.
Right. And then depending on how you have built your plan,
Mhm.
determines how much you as the employer have to put in. It could be zero. I mean, you could build a plan essentially, but that's not common. Most plans are what we call safe harbor plans,
If
where
you-
there's a minimum amount that you as the employer put in.
Yes, and the way the safe harbor works is the safe harbor allows you to get around a lot of those testing rules.
Right.
That usually limit highly compensated employees or the owners from participating. And the way the safe harbor works, there's a couple of different options. You can match dollar for dollar the first 3% and 50 cents on the next two. So if somebody's putting in 5, you're putting in 4. Or you can do a straight dollar for dollar in the first 4%. That's typically the two that I see the most. Or you can do a 3% contribution across the board.
For
So
everyone.
even if nobody's participating, you're still putting in 3% for them. Those are kind of the 3 safe harbors that I see. And in that scenario, you're able to get around a lot of those testing rules
Right.
and allow the owners to max out without any issues.
Yeah, and those percentages
So great
were
question.
built into your plan. So
Yes.
all we have to do is look back at your plan document.
Yep.
And we know exactly what your responsibility is toward those employees.
Yes, absolutely.
And so we have a 4% match.
Okay.
On their 5% safe harbor. Okay.
Yeah.
Good.
So as long as it's safe harbor, that's the main thing, allows you an opportunity as an owner or a highly compensated employee to max out.
Yeah. And I know this gentleman. I can follow up with him to make sure we
Sure.
have no other questions on that. Did anyone else write in on?
I don't think so. That piece.
Okay.
Those are great questions, though. We sure appreciate the questions.
Yeah, and Brandon, I think you have some information about some things that may be coming down the pike. There's potential changes to
Yep.
some of these plans, and they're quite interesting.
Yeah, I was actually going to just go quickly over just the Secure Act, which
Mhm.
was actually passed and put into law on 12/20 of 19. I know that feels like a lifetime ago,
Right.
pre-COVID. So it kind of got swept under the rug, but it did, that's what allowed the change on required minimum distribution from 70.5 to 72. It allowed on 401k plans, it used to be if somebody worked 1,000 hours or less than 1,000 hours, they were considered part-time and they didn't get to participate basically. Now there's a provision in there where if somebody works 500 hours, 3 consecutive years in a row, then you have to allow those employees to participate in the plan. So it's allowing more part-time folks.
Part-time, seasonal,
Yep.
those types of things.
Yep.
So we have to take a look at that.
There's also on IRAs, if somebody's had a newborn or an adoption, you can pull 5,000 out. There's some options to get some dollars there. That was not an option before.
Pull it out without penalty.
Without
Still
penalty.
pay the tax.
Yep, still pay the tax.
No penalty.
Yep, no penalty, which that just wasn't an option before.
Right, right.
And we all know having a child is way more expensive than $5,000. I wish it was just $5,000.
That's just the starting point, right?
That's just the starting point. And then parents also can pull 10,000 out of a 529, which is a plan we didn't cover today. That's more about education and college. We covered another time, but at least pull 10,000 out to pay off student loans. Which
Right.
get through college.
That's never been an option before.
Never
either,
been an
so-
option before either.
Yeah.
And so some of the new provisions that are on the table that are actually being talked about bipartisan, believe it or not, I almost hardly ever hear that word nowadays, but they are talking about taking that age 72 RMD number and extending it out to 75 because people are working longer. And in the Secure Act, they did allow for traditional IRA contributions. You used to not be able to make a traditional IRA contribution past 70.5.
Right.
You couldn't get the deduction. Now you're able to participate. You worked to 75. I was talking to a gentleman yesterday at a plan, one of our 401ks. It's 85, still working, still in great health, probably better health than me. But that particular scenario, so that person can make a traditional IRA contribution.
Which was always strange because other types of plans,
401k,
as long as you were working, you could keep making
Yes.
contributions, but now you can with IRAs.
Yeah, so they're trying to make all these different changes to enhance the retirement plan options that are out there for not only small businesses, but large, and allow more people to participate, which obviously we see statistics all the time, you and I do, where people are underfunded for retirement. And certainly we need to allow more and more people the opportunity.
And even worldwide, Americans are so underfunded on retirement. They have fewer savings than our citizens of most other nations, obviously other than third world type nations. But yeah, we as Americans are very underfunded on our retirement. So these are great issues here. I'm glad we're talking about it.
Yes.
Glad we've got this quite a number of participants on here today who are interested in their retirement future.
Yes, absolutely. It's about 10:50, 10:51. We've got about 10 minutes. If there's, I don't see other questions that have popped up. If y'all got questions, we can sit right here for just a few minutes and see if somebody's got some additional questions.
I'll just mention a few things. We'll see if any questions come in. In about a week or so, this webinar will be both on our website and on our YouTube channel. So be sure and take a look at that. If you can stand to listen to all this again, go
It's not the most exciting
or
topic in the world.
share it with your brother-in-law, whatever. Tell your friends. It will be available in about a week. Just check back to see our website or YouTube, either one. And then there will be some. Also, I'd say watch your email. Our newsletters and things are always giving information about upcoming webinars. So be watching for some additional webinars that are coming up in the near future. If you have questions about any of our upcoming sessions, Lynn Staggs here at the office. I started to say controls though. She plans and she coordinates all this, but yeah, she controls it too.
Fantastic.
She really does. Tells Brendan and I where to go and what to do. So, and we need that. So yeah, we be watching. There are more to come in the months ahead. So
do have a question. It says benefit of converting IRA to Roth and low tax bracket years. You as a CPA, you might want to jump on taking that question, but I mean, obviously, that's the best option.
Yeah, so if you have a traditional IRA, as we
Yes.
explained earlier,
Mhm.
when that is pulled out, when you take distributions, you got to pay tax on them. And assuming you're past age 59 and a half, do that without penalty. But anyway, if you want to convert that to a Roth, then yes, a low tax bracket year is the year to do that. Because what
Yes.
you certainly would not want to do that if you're in your high earning years and you're, at 37% tax bracket, that probably you may not have enough time to recoup the benefits of having that big chunk of tax taken out.
And when we saw the tax law change in January the 1st of 2018, it expanded the brackets, expanded that 22% bracket and the 24% bracket for everybody. We've seen a lot more conversions during this past 2 or 3 years because those brackets have been extended and there's been an opportunity for people. Generally, we see it more when you have retired and you're definitely down in those lower tax brackets, maybe doing some conversions. But we've seen more just because the tax brackets got expanded.
Exactly. So the point is well made. Yes, if you can foresee a tax year that's going to be lower than others, then
Or let's say you're a business owner and you have an off year. A
right,
lot of people in 2020 had an off year.
Sure did.
So looking backwards,
might have been a great year.
might have been a great year.
Can't really go back at this point.
No, unfortunately not. But if you think 2021 is still going to be a tough year for some reason or another, and you're going to be in a little lower tax bracket again,
Right.
could be a great opportunity.
Well, and that concept applies not only to conversions to a Roth, but for example, with my own parents, after they got up in age and there were some years where their incomes were lower and whatever, I took advantage of that. I
Yes.
was able to help them get their IRA money out at very, very low tax rates. And because I didn't want to inherit those IRAs at my tax rate,
And you're making a great point because on the traditional IRA, when that gets passed down to the next generation, the tax situation is exactly the same for your children that inherited those IRAs. Actually, in the world we live in today, this just changed. You used to be able to stretch that over their lifetimes and take it out. Now there's a 10-year window on a traditional IRA. Once the next level of beneficiaries, for the most part, there's a few nuances. You're not for your spouse, but for your children.
Right.
They've got 10 years to get the money out of that IRA. If they're inheriting a Roth, though, it's tax-free money coming down to the next generation, and they can take that as they would like to, whenever. They're not under some kind of rush.
That's a real good point. That 10 years gives you a lot of flexibility, though.
Yes.
You could actually take it out on the last day of the 10th year.
Yes.
If you chose, you just have to get it all out of that inherited IRA by the end of that 10-year period.
Correct.
So then that gives them the ability to look at from a year-to-year standpoint as to what brackets they're going to
work
be
with a
in.
good CPA.
Yeah.
On when makes sense.
Right. When does it make sense? Sure.
Yeah, these are fantastic questions.
Okay.
And that's been very helpful. Steve and I love doing this more when it's a live event and we can actually see people's faces. It gets a little more difficult when you can't see folks. But we sure appreciate the participation today. That makes it fantastic for us. Just Steve and I just sitting here talking about retirement plans could maybe put everybody to sleep, but it certainly helps with the questions.
Any other questions for us? If not, we'll say thank you, and
Yes.
we really appreciate you taking an hour of your day to spend it with us. And I hope you learned something. All you have to do is pick up the phone, call, or email us, and I believe our contact information is on some of the materials here.
Yes.
We'll get right back to you. Be thrilled to answer your questions and point you in the right direction, hopefully. So, All right. With that, we'll say goodbye and hope you have a great day.
Everybody, it's a beautiful day, so enjoy it. Thank you.